Welcome back to Stay in Your Lane. I'm your host today, John Maley, and brought to you by Triple T Transport. As you all know, favorite guest of mine, enjoy him immensely. Many of you have seen him on TV in the evening news and spots here and there. Chief Economist for Allianz Trade, North America, Dan North. Dan, thanks for being on.
John, thank you very much for having me. It's always a pleasure to come back every quarter and talk things over. And it's just like we were a minute ago. It's really good to get a insight and perspective from industry insiders, people that are really on the ground. That's very useful because, I have my own theories, which are not theories, but facts, which are very broad based.
You mean this isn't all off emotion for you? It's not all emotional? You just say, I'm feeling like this? You have to go out and you do a ton of research. I know you do. From the slides you share with us, I know there's a ton of effort that you spend on this on a continual basis, because let's face it, it's your job, and you work for the largest globally, the largest trade credit insurance company in the world.
Right.
So, the 5,000 plus people that rely on you making the right decisions and knowing what's going on all the time, now you know why you're the big value. That's why you get the big paycheck.
Well, I don't know about that, but I'm part of the value, and we do have all of our policyholders, as a matter of the policy contract, tell us every month who's paying them late, or how much, how far behind they are. So that gives us a pretty good feel as to what's happening on the ground. And of course, then we get claims for non-payment. So in different industries, our individual underwriters have a pretty close understanding of what's happening. I give the kind of the big picture view, which I hope is useful as well. So that said, I do have a few charts that I'd like to share that I think would be useful to look at, because the big topic that all economists are talking about almost all the time right now is the Fed Reserve and what the Federal Reserve is going to do. And I'd like to spend a time looking at that, why the Fed is doing what it's doing or not, and why it matters. So I'm going to bring up some slides here, if I may. Sound all right?
Sounds wonderful.
Okay, so what I want to do is talk about what the Federal Reserve is doing, and that kind of starts really with the inflation picture. And across the top there, I'm saying inflation still has a ways to go. That is, we haven't gotten it back down to where we would like. So the Fed, I think, is only going to cut rates one time this year. And we'll see, again, why that matters. Now, I say the Fed is going to cut rates. It's really, it's kind of important to know that the Federal Reserve doesn't manage all the interest rates in the economy. It really only has control of one interest rate. Convenient to say the Fed is cutting or raising rates, but they really only control one rate. That's the overnight Fed funds rate, the rate at which banks lend to each other overnight to meet reserve requirements. Banks do lend money to other banks, but it influences all other interest rates. If a bank has to pay more in interest to another bank, even for overnight, it's got to raise interest rates everywhere else, and it takes a while. So that's what I mean by when I say the Fed is raising rates. It's influencing rates everywhere. Now it's doing that to fight inflation, and I want to take a look at the chart on the left, which is the Consumer Price Index. The CPI basically is a basket of goods and services that a typical consumer would buy every month. So they go buy food and clothing and housing and gasoline. And the government counts literally hundreds of items that the consumer would buy every month, and then repeats the process the next month. and the change in the prices is what we call inflation. Now, the chart on the left shows the blue columns, which is the month-to-month change in inflation, and perhaps more importantly, the black line, which is the year-over-year inflation. So, for instance, in this case, it's showing that in May of 2024, that is last month, inflation was growing 3.3% over last May. Now, you can see here that this black line went up to 9% in February of 2022, which was a 40-year record. That is really, really high. And you can also see that on its way up, we went from 2% to 4% to 6 to 8 to 9 to back down to 8 to 7 to 6. The point of all that is that all those high inflation rates built up on top of the previous one. Inflation is cumulative. And that's what the chart on the right shows. It shows prices since January of 2021. For instance, wages have grown 16%. But the things that wage earners need to live, such as food, has grown up 21%, housing's up 33%, and gasoline at the moment is up 46%, although it's very variable. So this is the problem for, quite frankly, the administration. This is why Americans still do not feel great about the economy, even though everybody's got a job and even though it's growing at a reasonable pace. Things are still really expensive. And this is why, because prices have built up on previous prices. And that's why things still feel expensive, because they are. In fact, there's an article in the Wall Street Journal a while ago that says we still can't believe how much things cost. And I still get sticker shock on a lot of items. Like, how can it be? Well, it's because inflation is cumulative. Now, let me go back to this chart here on the left. Black line, again, the consumer price index. The Federal Reserve's trying to get this down towards their target of 2%.
2%, yep.
Yeah. And you can see here that the CPI has gone nowhere for 12 months. It's kind of traded in this channel and is at 3.3% now, and it's not gone anywhere for 12 months. So this is one of the reasons why the Federal Reserve says, I'm in no hurry to cut interest rates, because if I cut interest rates, I might stir up inflation again. Inflation is not near my 2% target. I need it to keep going down. So why in the world would I cut interest rates from that perspective?
Mm-hmm.
Now, so we believe the Fed is going to cut one time, probably in December. And then the question is, well, will that matter? And it will. It takes time, but it will. And here's why. All three charts show this dark blue line, which is that Fed funds rate. And you can see that the Fed funds rate influences almost every other interest rate. So this goes back to 1974. These are auto loan rates, and you can see they follow along pretty closely with the Fed funds rate. Same thing here with credit card rates, follow along pretty closely. And same thing with prime rate, business loans. The point is, if you have lower interest rates, there's more economic activity. So for instance, lower interest rate means more people can buy a car, more cars are sold, more people are employed to build cars, and so forth. So lower interest rates stimulate the economy, high interest rates slow it down. So we are looking forward to the point where the Federal Reserve will be able to to lower interest rates, to stimulate the economy, which is growing pretty slowly. And that's why it will matter. However, as I mentioned, inflation's not near the target. The economy is still holding up reasonably well by most measures. The labor market's still very strong. So the Federal Reserve is saying, I'm in no hurry. Inflation's not my target. And, certainly the economy is doing fine. I don't need to stimulate the economy by cutting interest rates. So I'm in no hurry to do anything. That's why they're sitting there. It will make a difference, though, because you could see how how all the other interest rates are so carefully correlated to the federal funds rate. However, once it changes, there will be a lag, and it can show up most profoundly in, for instance, mortgage rates. So here's the same dark line, Fed funds rate. Ignore the red circles for a minute. And here's another interest rate, the 30-year mortgage. So we can go back and see this picture looks pretty much similar to the other.
They're congruent, what you're saying, right? They run together for the most part.
That's right. All these interest rates do.
Mm-hmm.
And you can see when the Fed started to raise interest rates rapidly here, well, the mortgage went from 3% up to 7% really rapidly. So there's a very distinct congruence, as you say. So when we lower rates, we're going to get some more activity in the housing market. Well, that'll be great. But there's a lag. Every time what we call monetary policy, raising and lowering interest rates, there's a lag. It doesn't move instantly. And for instance, in the 30-year mortgage, that's very much the case. We go back to 1984, so that's just 40 years. When the Federal Reserve lowers interest rates, cuts interest rates like it does here, you can see a pretty big drop off. But the blue line, mortgages don't drop off nearly as much. And you can see in this case, the Federal Reserve cut interest rates pretty sharply, but the 30-year mortgage hardly moved at all. Same thing here, a big cut, not much movement. Same thing here, and we should expect the same thing going forward. There's a lag between movements in the Fed funds rate and other interest rates. And the way I like to think of it is an interest rate is a price. It's a price of money, and prices tend to be sticky coming down. They'll go up real quick, but it takes a while for them to come down. So it'll be great when the Fed cuts rates to stimulate the economy, which again we think won't be until December. It's still going to be a while before things are stimulated by that rate. Now,
3 to 5 quarters, isn't that normally what you tell us?
That's very good. Very good. Yes, that's right.
So if they were to change and decrease rates nominally in December, which I don't think it'll be a big change, if they do a nominal decrease in rates in December, then the next 3 to 5 quarters, we would maybe see some impact from that in a positive way.
Right. So you could argue, yeah, I'll see some impact more or less right away, but the full impact won't be felt 3 to 5 quarters. That's right. And in the meantime, after that first one in December of this year, in 2025, they're likely to keep doing quite a few more. Now, you get the same story in the middle in the manufacturing industry. The chart on the left is housing. In the middle is manufacturing. That black line, again, is the Fed funds rate. And the blue line is industrial production. And the point of this chart is, here's the Fed funds rate getting cut here, for example. And here's the blue line, industrial production, bouncing off here. There's a lag in there between where the Fed cuts and when the manufacturing sector recovers. Happens here, 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 here. The Fed cuts first, and then there's a while before the manufacturing sector actually responds positively.
Continue watching on the next episode of the Stay in Your Lane podcast.